Now, just moving on to the corporate bond issue, shares have had a decent run lately, but investors are still wary of them, and as a result, there's a boom in companies flogging a variety of fixed interest products, hybrid securities, subordinated notes, things like that. But as with most booms, there are pitfalls. In fact, ASIC has expressed some disquiet about the fixed interest frenzy. Here's Commissioner Peter Kell.
Look, we're concerned about the way in which risk is being explained for hybrids right across the market. So no, it's not just bank hybrids. In fact, there are other hybrids out there that have features that seem to pose greater risks for retail investors. The way in which advisors and brokers are pushing these products is certainly a concern. We're seeing an emphasis put on things like the household name rather than an explanation of the features of the product that may lead the consumer into difficulties. So it's not even so much the hybrid itself that's always the concern, it's the way that it's being pushed through commission-based sales that is really generating some problems.
And here's a list of the deals just in the past couple of weeks. As you can see, there's banks, utilities, gaming outfits, and look at the interest rates on them. Lots of different products, but they're all offering the same sort of pitch. It's all about lower risk. So what do you think of this? I mean, it seems to me that there's a lot of interesting issues about this. Commissions being paid to flog them, potential conflicts of interest, Marcus, if I may say.
Conflicts of interest. For the first time in years, in one of the toughest broking markets in years, we've got to sell something that people want and earn a commission on it, and it's the same as every other structure, and there is little point at this point going after the messenger. If you want to have a go at somebody about the plethora of note issues, have a go at the investment bankers that are creating them, who are tapping this golden vein of equity money, which isn't really going to care too much about the risk, because they don't see it as a fixed interest purist where they're going to price everything compared to bonds. As far as they can see, they're being offered 10 grand's worth of something that yields more than term deposits. They're probably going to own 4 or 5 of them anyway. It's going to be a small percentage of their portfolio. They are ignoring the risk, and they don't expect to be in the 30-year term that the note lasts for. They're going to be out in 6 months or a year whenever the stock market turns.
Well, the reality is that most financial planners and brokers don't understand the risks at all. They're more interested in the commission than the risk. I remember when Allco released their favourite, fabulous hybrids that were returning something like 10.5%, they found a plethora of people to sell them. Those things had a terminal value of 0. These institutions, the names that you had on the screen before, are not Allco. There's no doubt about it. Yeah. But they do carry risk. And the regulator struggles with risk transparency just right across the board, just as retail punters do and their intermediaries.
Well, with a lot of them, yeah, the rating agencies and the auditors are letting the companies count them as equity,
yes,
even though the investors see them as debt. So there's this kind of mismatch, isn't there, between the investors think they're buying equity, or sorry, they're buying debt products. The companies get to put them as equity on the balance sheet.
So in a way, it's the credit rating agencies have not quite got it right again, and it'll take a while for them to catch up, and then by that time this will be gone, perhaps.
You think it'll be gone pretty quickly, don't you, Marcus?
Oh, look, I don't think there's anything wrong with all these note issues. I don't think anyone's going to wear a bath. But I do think it is a little boom, and it will evaporate the moment the first one opens at a discount.
Or the next generation. So we're seeing the blue chip names structuring these things, very well with reasonably good security over underlying cash flows. What happens when we start seeing hybrids in the junior resource stocks and the hot stocks and being sold by this sort of, puffed up group of intermediaries who are getting commission sales? I mean, it's the same disaster that happened in the managed investment funds, and that's what they're concerned about.
You can sort of see it ready to happen, can't you?
And talking about stag profits on them too.
Yeah.
Amazing, here we are. So the market is so bad that people are trying to stag essentially fixed interest issues. It's a terrible reflection on the equity market.